Members, we formed a quorum. Let's call the meeting to order. First of all, this is a meeting of the Subcommittee on Securities and Futures, Contracts, Limits and Reportable Positions Amendment Rules 2015, Election of Chairman. The procedures for election of the chairman are set in Appendix 4 to the House Rules. So members, please nominate a member to chair. The nomination should be made orally by member and seconded by another member orally and accepted by the nominee. Nominations? Mr. Chen Kam-lam, can you second it? I can't second it. I can nominate myself. All right, I will nominate myself, and then Mr. Christopher Zhang second it. All right, I accept the nomination. Any other nomination? If not, then that's okay. We've got only 3 members, so I am elected as the chairman. So members, shall we invite the administration team in, please? Good morning. Welcome. Ms. Ada Chan, Principal Assistant Secretary for Financial Services and Treasury Financial Services 2, from the Securities and Futures Commission's SFC. Mr. Keith Loy, Executive Director, Supervision of Markets Division, and also Senior Director, Mr. Rico Lang, and also Associate Director, Mr. Stanley Ng, and also the Council, Legal Services Division, Ms. Amy Lam. Welcome all. All right, members, I believe that you've got the papers with you. There is a background brief on the amendment, so perhaps I would ask the SFC to brief us on the amendment rules. Mr. Loy. Members? The amendment is on the Securities and the Futures, Contracts, Limits and Reportable Positions. In order to minimize the potential impact of the futures and options contracts on the financial market stability, the SFC all along, in relation to the futures and options contracts, impose large open positions, reporting requirements and or position limits on the futures and options contracts. And they are listed in the SNF, contract limits and reported positions. Well, there are 2 parts to the amendment rules. The first part is on the 3 types of London metal mini futures contracts to launch earlier. We are setting the reported positions and the prescribed limits. And these are copper, aluminium, and zinc mini contracts. And for copper, prescribed limit 50,000 net long or short contracts, whereas for aluminium and zinc, the prescribed limit is 25,000 net long or short contracts. We've taken reference from the exchanges in overseas jurisdictions. We see how the limits are before we come up with the proposed limits. With regard to the reported position for these 3 types of contracts, we propose that it be set at 500 open contracts. In other words, any person who holds that amount has to report to the SFC. So that's the first part of the amendment. The second part is about the stock futures and stock options contracts on exchange traded funds ETF. So we are proposing that we introduce the general terms to include all stock futures contracts and stock options on ETF. There are now 6 ETF stock options contracts and 3 stock futures contracts on ETFs. So once the general terms are introduced, if new stock options and stock futures contracts are introduced, the existing rules, i.e. that those on prescribed limits and reported positions, will apply automatically to the new futures and stock options. So we don't have to introduce the new options or futures one by one, and they are automatically included. So this is our amendment proposed. We welcome questions from members. Mr. Sin Chung Kai. You said that you have taken reference from exchanges of overseas jurisdictions. Can you give us a comparison of how we are doing and the others? For the prescribed limit, well, this is proposed by the exchange, Hong Kong Stock Exchange, and we, SFC, will vet it and see if it is reasonable. For the 3 futures contracts, there are similar products. In CME, in Chicago, and also the Shanghai Stock Exchange, we've looked at these 2 exchanges and their prescribed limits. This should not be a sort of absolute comparison or direct comparison. Compared to Chicago and Shanghai, we are different in some areas. So in setting the prescribed limit, we may have different considerations. The first difference is that for Hong Kong's futures, we are cash settled. But for Chicago and also Shanghai, they have a physical delivery of the products. So for Shanghai and Chicago, the prescribed limit is set with regard to whether there are actually enough physical stocks to make the settlement. So that situation is rather complicated. So at the expiry of the contract month, then there will be a prescribed limit, and in other months there are other prescribed limits. So for us, we are cast as settled payment, and we have a total amount. So that's the first difference. Second, for Chicago and Shanghai, when they set the prescribed limits, after that is set, exemption is possible upon application from the market players. Say if a market player wishes to hold a larger quantity to do hedging, then they can apply for exemption from the exchange. And then very often exemptions are also granted. So that's different from Hong Kong. In our proposal, there is no exemption allowed. So these are the differences. Put simply, for the metal mini futures contracts, the prescribed limit is lower than the Shanghai Stock Exchange, but higher than the Chicago Exchange. I would like to follow up with a few questions. Higher, lower, well, it's difficult really to quantify it. Now, we are setting 50,000 net long or short contracts as a limit. What is the amount of these 2 other places? Second, can you tell me the risks that you have taken into account? Because for your regulation purposes. So what kind of risks are you referring to? You're talking about 2 different scenarios: reported position at 500 open contracts, and then for net long or short, copper is 50,000, and aluminium and zinc is 25,000. So what are the risks? Is there any overexposure? What are the risks that would surface in the market? Well, when we set the prescribed limit, the risks that we have regard to are 2 major types of risks. The first, since the 1997-98 Asian financial crisis, in some hedging funds, in the market, there was the problem of control of the market. Now, after the Asian financial crisis, we have set the practice of setting the prescribed limit. One of the objectives is to minimize market control, say, by certain players. So if we put a limit on the holding of the futures contracts by the market players, then there is less incentive for them to control the market. But the worry is a little bit less in types of financial or contracts, futures and options contracts. They are international commodities, and the risk is lower. This is one consideration. The other consideration is for the settlement clearinghouse of the Hong Kong exchange. Can they shoulder their risks? Now, if a player can hold as many contracts as he can, then it will bring a lot of financial pressure on the stock exchange if it closes down. So if several players hold contracts to the maximum limit, what is a financial pressure posed on the stock exchange? And after looking into that, by the limit that we would propose, the stock exchange can really resist shoulder the financial pressure in case the market players close down. Is there a reportable position now?
How much is that? We are now proposing that for the 3 contracts, the reportable threshold is 500 contracts. Anyone holding more than 500 contracts will need to report on the same day to us, so that every day we would know how many people are holding such contracts which exceed 500 in number, so that we can really monitor the market risks. Mr. Zheng Huafeng? Thank you. For the futures exchange, we do not have any physical delivery, and everything is, and all the transactions are cash settled. But there are not many investors in Hong Kong. If we want to attract investors from the mainland, we need actual physical delivery. So would it be the case that your proposal would not really attract them, and there will be fewer participants in the market? To answer Mr. Zheng's question regarding these such contracts and whether or not after we put forward these proposals we can attract more people to participate in the market. In Hong Kong, the general investors normally do not have very much interest in investing in commodities. The exchange, by introducing such contracts, would like to actually introduce new markets to the new products to the market participants. After these products were launched this year, the daily turnover is only about 250 contracts per day, compared with Shanghai or CME. It's much smaller. At the moment, you might say that we're still at the pilot stage, and by introducing these products, we hope more people will know about these products. So are the transactions on these such metal commodities traded in the form of ETF? Well, actually, it's traded on the futures exchange, and it's traded on the same platform as the transactions on index futures. So at LME, they also trade such contracts. So why don't we simply trade these contracts on the LME? I think the trading hours, well, these products are traded during the trading hours of Hong Kong. I think so these products will be sold during the trading hours of the Asian region. And these products are not exactly the same as those traded on LME, although the metals, the underlying metals, are the same. But the design of the contract and the fact that such contracts are now settled in renminbi and the size of the contracts are also different. At LME, the LME is a more mature international mercantile or market. So they are much more developed than we are. I think Mr. Lei was comparing Hong Kong with the futures exchange of Chicago and Shanghai. But if we compare Singapore with Hong Kong, does Singapore have any position limit? Do they restrict the number of contracts? I understand that the Singapore exchange do not have similar contracts. Normally, the Singapore exchange have position limits on certain stock futures and stock options contracts, but they're more lenient in the sense that very often they would allow exceptions to the position limit and allow people to hold a larger position. But the trading is not very active in Singapore. Alan Leung. Well, I'd like to further, Mr. Christopher Jiang, could you wait for your second round, Mr. Alan Leung? Thank you. Of course, I understand that the legal notice is issued by the SFC pursuant to CAPS 571. And for the stock futures and stock options contracts, you're proposing to set a position limit. But what you are, the stock futures and stock options contracts, as I think before the notice comes into effect, is it necessary for these contracts to be reported? According to CAP 571, the SFC may from time to time review the limit on certain stock futures or stock options contracts, and also the where do you draw the line in terms of the reportable positions. Now, what I'd like to know is whether you have any objective criteria to help determine or to help the SFC determine and conduct timely review and then put forward proposals as the ones contained in this legal notice. Thank you, Mr. Leung. To answer your first question, our usual approach is that the stock exchange from time to time will launch new stock options or stock futures or contracts. Every time they launch such a new contract, they would also impose a position limit and the reportable positions for these contracts. Mr. Leung is correct in pointing out that every time the exchange launches a new product, we will not be able to add these new products into our rules. Whenever the stock exchange issues new contracts, the position limits and the reportable threshold are there, but every year we would look at the together with government, look at the timetable, and from time to time incorporate the new such new products and then determine the contract limits and reportable positions for these new products so that the people will not break the law. We would also from time to time review the position limit on existing products and see whether or not they are appropriate. We basically would base our decision on two considerations. For every contract there is a reporting requirement. Nowadays, for any contract, we would like to know what is the position held by the investors. If we know that many people are already nearing the ceiling of the position limit, and it would mean that the market would need to relax or increase the position limit. So it really depends on how many people are using these contracts in the market. And for each stock futures and stock options contract, there are the underlying products. Say, for example, for financial products, the underlying product would be the stock itself. And we would take a look at the stock market. the development of the stock market, the market cap, the turnover, as compared with the position limit of that particular stock futures or options. If the turnover in the stock market, if the market cap has increased, then the position limit may need to be would need to be adjusted. We will look at the underlying what happens to the underlying stock to help us determine whether or not we need to review the position limit and the reportable threshold. We normally would not change that easily. If the limit is set at 500 contracts, people who are responsible for making a declaration, if they're used to the threshold of 500 and we change to 1,000 tomorrow, they will not find it very difficult to get used to that. So we do not frequently change the threshold. Sometimes when we need to make the change, we may discover that if we maintain the same reportable level, many people's position are lower than that. So sometimes we may not have full access to market information, at which time we have to review whether we need to adjust the reportable limit. Now, if that's the case, the so-called position, the contract limits and the reportable positions are actually means by which the SFC will track the state of the market and to find out whether there are people manipulating the market. It is one such tool for you to do that. That's correct. Yes, sometimes through the reporting requirements, we have found that some people hold very large positions in the market. And if necessary, we may ask that person, what is the purpose of holding such a large position? And after we've learned its purpose, it will help us better, monitor the market and know where the risks are. Xin Chung Kai. I don't understand really how it actually operates. If I buy a stock, I will buy my stock through a broker, and the broker may hold the stocks in custody on behalf of the customer. I don't know whether or not the arrangement is the same for these contracts, and that you would trace the position of each customer, because for a broker, after he has net the position, that position is different from that of his customer. And for a large brokerage firm, they may have 3 or 4 brokerage licenses. Would you count them according to the number of licenses, or would you treat them as one single entity? Well, thank you for the question. I think the position limit and the reporting limit would actually be based on the individual. If I buy, stock futures through a brokerage firm, I think the investor himself is responsible for making the filing the report. The broker may also conduct transactions, but his trades should be separate from those of his customers. But we understand that sometimes the customer depend on the broker to help them to go to process all the formalities. But the reporting obligation is placed on the broker and the customer. So both parties have to comply. What the broker needs to do is to remind his customer whether or not he has exceeded the position limit. And once he has reached the reportable threshold, then the broker has a duty to make such reports on behalf of the customer. We've also issued guidelines so that if both the customer and the broker make declarations, if one party has reported already, the other one doesn't have to do it. Again, Mr. Sin, of course, with these rules, you have the power to impose sanctions. So who will you punish? I mean, if the broker forgets to make the report, do you punish both, or what? How do you deal with non-compliance? I think both parties will have to shoulder the responsibility. When we consider the question of penalty, we can impose the penalty on both parties. Very often in the past, the brokerage firm or the investment banks may have problems in terms of internal control. They may have forgotten that they need to make a report, and they made the wrong report. And once we discover the mistake, the penalty will be on the investment bank or the brokerage firm, because there is something wrong with their own internal control. So normally you say the responsibility to arrest with the brokerage firm. You punish the brokerage firm. Yes, we can also punish the investor depending on who holds that position. Sometimes the brokerage firm holds the position itself. So if they forget to report their own proprietary trades, then of course the brokerage firm will be punished. That's understandable. If the broker buys the stocks and the contracts himself, he will be punished. But if the brokerage is a certain company, if a certain company entrusts the brokerage firm to do the trades, and such trades had exceeded the reportable limit, and he has not reported to the SFC, so are you going to punish the broker or the investor, or the company making the investment, or do you punish both? I think normally there's an arrangement between the broker and the customer. If in most of the cases the broker will submit the reports on behalf of the customer, and if something goes wrong with the system of the broker and he failed to report on behalf of the client, and if you find out that it's not the customer who didn't want to report, then perhaps the broker will have to bear the responsibility. It would depend on the circumstances of the case. So your power to impose fines, and what are the sanctions that you can impose?
Summary indictment will lead to a fine of $100,000 and 2 years imprisonment. And there may even be a 6 months imprisonment term. You have to go to the court, right? Yes. $100,000. Do you have to take the person to the court? Well, this is summary indictment. The SFC can do it on its own. So you don't have to go through the DOJ. You can do it yourself. You can directly prosecute the person. So you have to go through the prosecution procedures, because I know that there are clauses under which you can actually directly fine them. Yes, this is just a fine imposed on the person without going through the court. Yes, we have to go through the court. So I think the jail term is necessary. I mean, you have to go to the court to take them to prison, right? What about imposing a fine? Let me add, for most futures and options, the position is held by the licensee of the SFC. And for positions exceeding the limit, they are really held by the licensee of the SFC, and it is because of their negligence that they failed to report. In light of this, we can also take out disciplinary action against the licensee. Well, this is something additional, right? You said most of the positions are held by the brokers or the licensees. You have got 9 types of licensees, which licensee type 2, which deal with futures contracts. You said that most of the futures are held by the licensees. Are they actually in effect held by the investors, or they are providing custodian service, or what? Most of them are held by type 2 licensee. Perhaps the customers would like to buy futures contracts and they are buying them on behalf. There are no physical products involved in futures. So the only thing that is needed is the margin transfer between the customer and the broker. Unlike the stocks, there is no custodian to talk about, and the brokers are holding the margins for the customers. and the margins may be handed over to the exchange by the brokers on behalf of the customers. And if they earn a profit, the brokers will then transfer the margins to the customers. And each customer has his own account. And as for the reportable position, that has to depend on the position held by individual customers. You don't seem to be very consistent in what you two said. The licensee will collectively hold positions of a dozen or so customers, and then they have net position and they will report on them? Or is it the case that they have to report the position of individual customer or client? The broker has a transaction relationship with the exchange. He has also a transaction relationship with the clients. And on behalf of the clients, he will hold the positions. He can report collectively all the positions. So let me ask once again. You are asking the broker to report individually the positions he holds. Mr. Lang? Mr. Lang just now said that most of the futures contracts are held by the brokers. So in other words, there are no individual investors to talk of. Mr. Lang, can you take that question? Can I give you more details on this? Normally, say if I'm a brokerage firm A, I have 10 clients, and the 10 clients through myself buy futures contracts. And the requirement on the brokerage firm is that he would look at the positions of individual client and whether the limit is exceeded and whether they are in the reported position. If that is the case, he would have to report the case to the exchange on the positions of the individual client. So he can't do it collectively. And also, for some brokerage firms, they will also buy futures and contracts as their own business. They may speculate on them. So that that would be put into the company's account separately. So when they try to see if they have exceeded the limit and they have reached the reportable position or not, then they have to deal with their own accounts and their clients' accounts separately. We found that actually in Hang Seng Index futures and Hang Seng H futures contracts, most of the positions are held by the brokerage firms and investment banks. These are their own businesses. Well, they may do some transactions for the clients in the market, but then if they want to hedge against the transactions, and they are using the futures contracts market as a hedging means. So that's why the positions are held by themselves. So most of the futures and options contracts are held by the brokerage firms themselves for a hedging purpose. Now you are seeing something new here. Now we're talking about metal futures contracts here. You mentioned about stocks futures just now. Mr. Alan Leung asked this question. You have already started imposing this reportable position requirement. You have some sort of experience on that already. Now the rules will commence on the 16th of January. You must have a certain grasp of the existing situation. Is it the case that actually most of the transactions are done by the brokerage firms, or they are doing it on behalf of their investors? I'm sure that there are many sort of institutional investors in this market. Can you confirm that? To many people, well, they would just buy certain futures contracts and then they will leave it to the brokerage firms to handle them for them. So ultimately, who should bear the responsibility? Thank you, member, for your question. For the London Metal Mini Futures contracts, as Mr. Leung said, since the launch of the products, well, the market has not been very active. Transactions are few. For the 3 contracts, well, every day is just 240 contracts in transaction every day, and the reportable position is just 500 or so contracts. So far, there is no one holding over 500 open contracts which needs to be reportable and and also there is no one who holds positions exceeding the limit. So, well, when the rules come into effect, they will not have any impact on the positions, existing positions. 80% of the transactions are done by the market makers. Now, apart from the market makers, another major category is the professional institutional investors who speculate on futures contracts. They account for 10 to 20% of the transactions of these contracts. My last question. For professional institutional investors, I presume they should have adequate knowledge to do the reporting. Now, the transaction volume is rather small now, but for the market and for the small investor, is there a mechanism to inform them or notify them that they have reached the reportable position? Mr. Leung, there are 2 ways to do it. First, the exchange will do promotion. When they launch products, they would remind investors of the requirements, say, for example, in terms of reportable positions and deposits and margins. And also, secondly, the brokerage firms. The brokerage firms, if they see that the clients' positions have reached the prescribed limit, the brokerage firms should notify their clients of the requirement for reporting it. Mr. Christopher Zhang? Metal mini futures contracts are not derivatives of the stock market. Well, what kind of license should they hold when they deal with it? They can just hold a Type 2 license. Is there a separate settlement company or clearing house? Well, under the futures exchange, there is a clearing house, separate from the stock exchange. So we are referring to the client's positions and not the brokerage firm's positions. But futures contracts can be set up. And there is a client which sells the futures contracts and another one buys them in. For the brokerage firm, would they be handing over the margins to the futures in excess of the requirements? Because we will not be able to notice how the offsetting is done. So are you aware of this risk? Thank you, Mr. Leung. For the exchange, as we know, to my understanding, the brokerage firm can only offset different futures held by the same client. So if one holds long contracts and the other short contracts, they can't be offset and then report the net contracts to the exchange. If there is great volatility, do you have a mechanism
to collect marks?
Margins should be collected for a transaction, And if the market fluctuates, options is higher than a certain percentage, the brokerage firm must notify the client that he should pay the margin. There is indeed a collect marks mechanism there. Any further question? So I would like to tell you, well, we've already completed scrutinizing the rules. The timetable is the expiry of scrutiny period 16th of December 2015, and date of reporting to the House Committee is already passed or lapsed. It's 4th of December. We must ask for an extension after scrutiny period. We must ask for an extension to the 13th of January 2016. I would report to the House Committee, and that will be done on the 18th of December 2015. And the deadline for giving notice of amendment to the subsidiary legislation is 6th of January 2016. So we would ask for the scrutiny period to be extended to the 13th of January 2016. If colleagues have no further questions, do you think we need to go to the clause by clause scrutiny of the amendment rules? Well, this is a rather simple amendment. All right, let's go to the rules clause by clause. Who to take us through it? Mr. Lang. I suggest that we use a marked up copy, the Chinese version. There are several amendments here. The first one on page 1, interpretation. We suggest adding the definitions of 4 terms, and these have to do with the stock futures contracts and stock options contracts on ETF. On the right-hand side, on page 1, there is a triangle there. Next to it is exchange-traded funds. Our suggestion is that it should mean an open-ended collective investment scheme, the shares or units of which are listed or traded on a recognized stock market. In simple terms, it includes the shares or units of which are listed or traded on a recognized stock market, the Hong Kong Stock Exchange in Hong Kong. There is also a term, open-ended collective investment scheme. The definition is set out here. Let's move on to the last part. Open-ended collective investment scheme means a collective investment scheme of the following, and that is the shares of units of which may be repurchased or redeemed at the request of any of its shareholders, unit holders, at a price calculated wholly or mainly by reference to the net asset value of the scheme. And in accordance with the frequency for repurchase or redemption requirements and procedures set out in the offering documents or constitutive documents of the scheme. In B, there are 2 terms, offering document, constitutive documents. So we have also provided the definitions of offering documents and constitutive documents here. Offering document in relation to a collective investment scheme means a document of the following: inviting participation in the scheme by prospective shareholders or prospective unit holders of the scheme, and containing information relating to the establishment or administration of the scheme. Constitutive document.
That is in relation to a collective investment scheme, means the principal document governing the establishment of the scheme. all these four terminologies. I think we hope to include a general terminology to cover all the stock futures and stock options contracts traded in the exchange. For all these four interpretations, well, I think in February this year we had the Stamp Duties Amendment Bill which was enacted, and in that ordinance we have provided a definition for ETF. So the definition here is exactly the same as the one in the Stamp Duty Amendment Ordinance. Could you pause here? Mr. Sin Chung Kai, you have a question? Yes, I have a question regarding the interpretation. I find it very odd that the term exchange traded fund, ETF, has been, used in the market for many years. But over the years, I thought you already had a definition. I thought there already exists a definition in the SFO. But now that it is only now that you're proposing to offer a definition. So you do not have a definition for ETF in the whole ordinance. Is that right? But other than the provision proposed here, we do not have any other regulation. Could we give him the microphone? We can't hear too clearly. We use the collective investment scheme. That has existed all along. And very often when the exchange launches any ETF, it is only one of the products, offered by the exchange. Over the years, the practice is that the exchange will tell us they want to launch an ETF. The SFC will, through the collective investment scheme model, vet those products, and then subsequently the exchange will launch these products to the market for trading. And this is how they launch the new products. But now, this is the time we think we need to provide a clearer definition. Okay? Just one more question. You have another specific definition for open-ended collective investment scheme. I think all along we have always had a definition for CIS. Well, we do have a definition of CIS in the Securities and Futures Ordinance, but we've added because we have schemes which are closed-end, but we've now proposed to have the open-ended CIS, which means that such schemes could be redeemed. The fact that we don't have open-ended CIS means that all these schemes are closed-end. So what's the difference between open-ended and closed-ended? Open-ended means that the scheme, when it is launched, it would allow investors to say to the fund manager that he would like to purchase more shares of the fund. And whether or not the fund manager can, offer more shares or create more shares or more units for him to buy. So for the open-ended CIS, there is a mechanism to allow the investors, normally the large investors, to say to the fund manager and about their intention to buy more units or they want to redeem the units. Closed-end means that the fund would issue 1 million shares and that's all. It would not issue additional shares. To issue new shares, it would need to go through a very cumbersome procedure requiring the consent of all the unit holders. For a closed-ended scheme, the outstanding units are fixed in number. For open-ended schemes, that number may vary from day to day. That's the main difference. Okay. Please go on. Next, we move on to page 2. The amendment to Schedule 1. In Schedule 1, we have listed all the stock futures contracts and the position limit and the reportable level or position limit. We propose that After contract number 13, we add 4 more. That is number 14 to 17. 14, 15, 16 are the London metal mini futures contract. Number 14 is the London copper mini futures contract. We propose that the limit should be 50,000 net long or short positions for all contract months combined, and the reportable limit is that 500 open contracts for any contract month. Number 15, London aluminium mini futures contract. The limit is 25,000 net long or short contracts for all contract months combined, and 500 open contracts for any one contract month respectively. Number 16 is zinc. Again, it's 25,000 net long or short contracts and 500 open contracts. And for item 17, this is the stock futures contracts on shares or units of exchange-traded funds. We propose that the position limit should be set at 5,000 open contracts, and the reportable threshold is 1,000 open contracts. For item number 17, the discrepancy is very small. For 14 and 15, for any contract month, the limit is 500 open contracts. Anything exceeding 500 contract, you would need to be reported. For this one, is 1,000. So why the discrepancy? Are you referring to the 16 and 17? 16 is a metal contract. 17 is not metal. Yes, I can see that. Well, this is because the underlying products are not the same. One is metal, the other one would be shares or the ETF. Can you give us some examples what these are for number 17? For 17, for futures, the underlying products are either the Hang Seng Index. We have the Hang Seng Index futures products. That is the most common. The other one is a single stock. A single stock can also have its own futures, but they're not actively traded. Every day we have about 1,000 odd such contracts traded every day. This has been introduced by the exchange for many years, and these products are also traded overseas, but the transactions are very active. Anyway, if you buy the futures product, the underlying product is a single stock, HSBC for example. Since it is a single stock, we're not saying that we'll do away with the stock, and we just call it now the ETF, which is traded in the cash market. And then the stock futures is based on the ETF, traded in the cash market. And the limit is 5,000 open contracts. We didn't have ETF before, so we're just adding ETF here. 5,000 is not a lot. Well, but that's because the market is not very active. Investors normally are not very interested in these transactions for the moment. For the stock futures position limit, we use the stock futures, a position limit to determine the limit for ETF. People are now used to the threshold of 5,000. If in future the market develops further, we can talk to the exchange and see whether we need to expand the limit. Okay, please carry on. Next, the last page, the proposed amendment to Schedule 2. And this is in respect of the stock options contract, the position limit, and the reportable threshold. We are now proposing to scrap number 2, item 2, 3, and 4. At the moment, there are 3 ETF, stock futures contract, namely the tracker fund, the iShares FTSE, and the WRSC China tracker stock options. We propose to scrap all these and use a general terminology to cover all ETF stock options contract and the ceiling, the contract limit. and the reportable threshold. We propose to add item 2, which is stock options contracts on shares or units of ETF. The position limit and the reportable threshold are the same as those which apply to 2, 3, and 4 at the moment. That is 50,000 open contract per option class in any one market direction for all expiry months combined, and 1,000 open contracts per option class per expiry month. And the requirement is the same as the current requirement. So should there be any adjustment, they will also be, these will also be included. Yes. Any questions, Mr. Cheung? No? Right. If there are no questions, we finish with our clause-by-clause scrutiny of the rules. As I said, we will apply to the President to extend the scrutiny period to the 13th of January. If colleagues have no further questions, I think we have finished with the scrutiny of the amendment rules. Since there are no further questions, I now declare that we are adjourned. Thank you very much.